So good afternoon. After the lunch, of course, it's a bad news and good news. Bad news is that after the lunch, it's always a tough panel. You have to stay awake. But the good news is that after this panel, you can go to the beach. And even the better news is that you have a fascinating panel here to continue discussing where Catherine stopped. No? She stopped pretty much asking herself whether her job as a historian is coming to an end because the digital means of payment will take over. There will be no more correspondent banking, etc. And this is a little bit something of which people around this table have to say because I will ask them how they see these things going forward. The title of the panel is Stablecoins and Monetary Policy, but it's actually broader. Some of people here will talk about the tokenized deposits. I will talk about the stablecoins. I will put a little bit more emphasis on the CBDC, as far as I understand. So these are different means of digital means of payment, basically, I would say, unified by the distributed ledger technology, but different options that we see in front of us. Now, I say if it was for the 300 billion US dollars of stable coins now, we would not have this panel because it's so small that it doesn't really deserve too much attention. And although it has risen, basically the amount of the stable coins doubled within the last 2 years, it's going from very small to still very small now. So what I would like to ask the panel is, imagine the world in which Catherine loses her job because we really get that many stablecoins or tokenized deposits, that it really changes the way that the payment system operate, but then it changes a lot more. It then changes probably the transmission mechanism of monetary policy to the banks to their clients. Maybe it changes the way we think about the zero lower bound. Maybe then it changes the architecture of the world international finance. It's not going to be what it used to be then, if it happens. So first question for my panelists will be, where do you see the digital means of payment in next 5 to 10 years? Do you believe that they will be irrelevant, or you think they will take over? And regardless of what you answer, then they'll ask you, imagine that they actually grow maybe more than Scott Bessent thinks they will. And what does it mean for bank client relationship, demand for the safe assets, monetary policy transmission, etc. So who is here with us today? On my left, I'm starting from my left, David Andolfatto from University of Miami, but former also Fed. And he likes the topic, I know. Megan, also good old friend and also good old friend of this conference. Megan Greene from the Bank of England. Chris Kopf from the Union Investment, also not first time here. Brunello Rosa from the Rosa and Associates and at Bocconi University. And last but not least, Chris Waller, who is a person that knows a lot about this topic and is in a way in charge of many things that we'll be talking about at the largest central bank and the most important central bank in the world. I have to say that, although I'm taking the new job on Monday, I have to say that. So, Chris. So, without further ado, you know where I want to go, and maybe David, we start with you, and then go.
How shall we start? Opening remarks?
Opening remarks, but try to answer my first question. Where do you see the digital means of payment in 5 to 10 years? Do you think that we are discussing something which will become really relevant, or we're gonna stay small?
Well, I think that in the conventional sphere, I think what you can see is a growing emergence, an effort to tokenize bank deposits, securities. I know I saw a recent talk by a representative from BNY. I mean, they're full on this. So I fully expect to see that sphere develop very rapidly. One question is whether or not these tokenized objects are going to be managed on in-house ledgers, or whether or not they'll be permitted, like a lot of the stable coins, to run off of these public blockchain rails. That's something I look out for. But in terms of whether or not these stable coins will ultimately grow sufficiently large to take over or become systemically important, I think it's worthwhile to just speculate. You know, as policymakers, we have to be prepared for all contingencies, even if they are unlikely. For myself, I see that the stable coins that are fall under Genius and MiCA compliant, I don't see much of an issue. My own concern is, something like an offshore stablecoin, something like Tether, which happens to be the world's largest stablecoin. As Helen pointed out yesterday in yesterday's luncheon talk, these entities like Tether are not directly subject to U.S. regulation. You can't tax them directly, but there are other ways to do this. And why would you want to do this in any case? I mean, I think you have to imagine of these worlds that might arise. You have to imagine, for example, that Tether grows in such a way that it starts to, that it becomes an important way for firms along the global supply chain to finance their global payments along the global supply chain. I mean, that's not happening right now, but it's something that's not inconceivable. It's not something that might happen in the future. And then you have to ask, well, what might possibly go wrong if Tether was to be, say, much larger, even though they've slowed down now, they might get much larger in the future. What could possibly go wrong? Well, we know we have examples of runs on kind of money market funds, like things that can go wrong. Tether's either going to defend its peg, or it's going to not defend its peg. As far as Tether is concerned, I don't think that Tether is legally obligated, legally or contractually obligated to redeem its liabilities at par and on demand. So I do believe Tether reserves the option to actually, like any fixed currency regime, to revalue its currency, say at 90 cents on the dollar. We've seen this many times in the past. Alternatively, Tether might be interested in defending its reputation. It would have to sell off assets on like U.S. Treasury securities. This could happen off regular banking hours because Tether operates 24/7. And then the question is, what could possibly happen? Tether holds a lot of U.S. Treasury securities. What if they start instructing their custodian to start selling these things off en masse? This would put the Fed in a very difficult position. The optics would be terrible. And you can see the headlines right now. Governor Waller bails out unregulated shadow bank.
Ain't gonna happen, man.
So what can you do if you can't get them directly? I've advocated perhaps going indirectly, take the indirect route, maybe go at their custodians, perhaps insist that Cantor Fitzgerald adopt a more fiduciary type of role. Or perhaps even prohibit U.S. institutions from providing custody services for offshore entities like Tether. I mean, I think if that were to happen, I wonder if even Tether could even exist, as a U.S. dollar-based coin. So anyways, that's my 2 cents worth on that.
Thanks, David. Megan.
Yeah, thanks. First of all, thanks for having me back at DEC. I love a conference where sunglasses are on my face or on my head almost all the time. Thank you. So thanks for having me back. I should also say these are very much not the views of the Bank of England. These are my views on digital assets. I think it's worth first asking what the point of them is. So what problem are we trying to solve? And to my mind, the problem we're trying to solve is to tokenize assets so that you can embed contracts into them so that when you have a delivery of a product, all kinds of transactions are automatically set off, payments, margining, compliance, all of this in what's called an atomic settlement. Who doesn't like an atomic settlement? So I think that's the idea. It makes payments, and particularly cross-border payments, much faster. These these settlements don't, they can happen on a Sunday. They don't have bank holidays. They can happen around the clock. So it's much faster. It's much cheaper. It also frees up a whole lot of liquidity. And to answer your question, Boris, even if you don't like these digital assets, like the ship is out of the harbor, they're here to stay. So I think it's worth engaging with them and thinking about the design. And when it comes to the design, I think the most important thing is the singleness of money, as Helene said yesterday at lunch. So, one stable coin is $1 backed stable coin is worth the same as a central bank dollar, which is worth the same as cash. That they can all be interchanged. So that, as a central banker, I think is paramount. But when it comes to the design of these and which ones are going to take off or not, I like to think of it as a massive race between the tortoise, the hare, and the rhino, I'll say. So the tortoise is a central bank digital currency, a wholesale one. The hare is stablecoins, and the rhino is tokenized deposits, in my view. And I think we'll probably end up with all three. But if I had to put my money in one, no pun intended, it would probably be the rhino, actually. So tokenized deposits, which I think will probably take off. I'll just go through some pros and cons of each quickly, and we can talk more about it in the next round. But when it comes to a central bank digital currency, obviously the biggest pro is that central bank money is the safest asset there is. So you have no credit or settlement risk whatsoever. It plugs right into the existing banking system, so that speeds up its development to some degree. You have anti-money laundering and know your customer protocols that still exist. There are a couple cons, though. For those of us who work at central banks, we know they're massive bureaucracies and don't tend to do stuff quickly. So even the digital euro, which you guys have been working on for years, probably won't come into existence until 2029 in the face of a pretty immediate threat. I mean, you don't hear digital euro without strategic autonomy in the same sentence. So even in the face of a pretty urgent threat, it's going to take another 3 years. And it could pull deposits out of the banking system, which obviously kills off banks' business models. But central banks don't know how to evaluate loans and things like that. We need banks to do that. So depending on the design, I think that's a risk. Stablecoins, which are the hare in my Aesop's fable, are backed one-to-one by real assets. They weren't really going anywhere until the U.S. government threw all of their weight behind stablecoins. And now they've really taken off. About 98% of stablecoins are backed by dollar assets. They do all the things that I said at the beginning was the goal of digital assets. So they speed up transactions. It frees up liquidity potentially. It's developed by the private sector, so it's coming along much faster. Commercial banks are putting tons of money into the infrastructure around it. The biggest con to my mind is that stable coins are just not all that stable, which I think is an issue. There's a question about what exactly is backing them, where it's regulated. Tether is based in El Salvador. How are we going to regulate that? In the US, there's some state level oversight, and there you get states actually competing with each other to attract stablecoins. So my understanding is that Wyoming's becoming kind of the Rhode Island of stablecoins, where they've got a lighter touch regulation, which is worrisome. And it also, it affects the monetary transmission mechanism. If we're no longer operating through banks, it weakens the sovereign monetary authority. I think of the three, if the point is, or what's paramount is maintaining the singleness of money, it's the hardest to do with this one. You can regulate it. So the Bank of England has actually made an attempt to regulate it. In fact, the Bank of England's created an entire ecosystem for pound-backed stablecoins, which don't really exist. So we've created the ecosystem in the hopes that it will come. But according to our regulation, for a systemically important stablecoin, they have to stick 40% of their backing assets at the Bank of England, not making any money at all. And the other 60% can be in short-term government debt. My colleague tells me one of the crypto exchanges took out an ad on the Tube in London against this. They're so livid about 40% not making any money. So I don't know that we've nailed it when it comes to the regulation, but I think that's a huge problem. Most of the illicit transactions in the crypto environment involve stablecoins. So it's an on-off ramp for crypto. I think it will remain such. But I actually don't think that that's where the future is going to be because of the problems that I mentioned. I think that these are going to be overtaken by tokenized deposits, probably. They're just digital representations of traditional bank deposits issued by regulated banks. So we get to keep all the lessons we've learned from previous financial crises. Anti-money laundering, know your customers still intact. The user experience doesn't really change. The problem is they haven't really taken off. In my mind, I think they haven't taken off because commercial banks don't want to lose the fees that they're getting, but I think they're probably going to lose them anyhow. And once they realize this, actually, they will put more into developing these. Helen also mentioned there ends up being liquidity fragmentation. So if you're using one bank's digital tokenized deposits, you can't really jump over into another bank's system. There are a lot of efforts to try to fix that. And that's not a small con. I'm not overlooking that, but I do think we'll get over that. And so, like I said, I think we're likely to end up with all three globally, but I think tokenized deposits are probably going to take over stablecoins. And in 5 years from now, I suspect we might wonder why we were talking about stablecoins so much.
Okay. Thank you. Pretty clear where you are on that. Chris?
Yeah, I actually prepared some slides. So my answer to Boris' question is on slide number 9, just to get prepared. Last year, we spoke about CBDCs here. That is on the left-hand side of that chart. This year, we're talking about stablecoins. And stablecoins, in my view, are not currency. They're assets. Yeah. So we'll get to that later. And just to show you where the biggest stablecoins out there is Tether. Then we have Circle. And there is a European initiative called Q-Valis, which is starting to issue a stablecoin as well. These are reserve assets meant to keep a peg to a currency, but they're not a currency. And as currencies, they're also not interest-bearing. The alternative, as Megan has pointed out, are tokenized bank deposits. We've got the JP Morgan dollar, and we've got the Great British Tokenized Deposits, GBTD, which are in the making. So that is the new thing out there. The death of CBDCs in the United States. The guy at the Fed who was responsible for that, Mark Gold, has resigned. And in Europe, they failed. Yeah, the rapporteur at the European Parliament who tried to slow down and prevent the introduction of CBDCs has changed his mind. So alternative to crypto assets, so they basically stopped it and took control of Congress and of administration to stop CBDCs. Yeah, so that's the state of play on CBDCs. Now, here you look at stablecoins. As Boris has mentioned, they've seen a good growth, but interestingly enough, since October last year, they stopped growing. Yeah, which already may indicate that there is very limited use to stablecoins. We're talking about 300 billion, and that market is not growing. It's a duopoly with Tether and Circle basically sharing almost the entire market. On the right-hand side here, you can see Euro stablecoins, total market cap 500 million. Yeah, it is the Circle in Euro. That's the only euro-denominated stablecoin I could find. So according to my numbers, 99.8% of stablecoins are dollar-denominated, and there is only a very small portion which is euro-denominated. And on the left-hand side, you can see the dominance of the stablecoin market by Tether and by Circle, both in terms of market cap and in terms of transaction volume. So we basically have two coins that dominate the market, and the euro market is not present. It doesn't exist. There is no stablecoin market in Europe. So, I mean, I can already say why this is not the case. What are the main use cases for stablecoins? First of all, is digital or crypto native people who want to trade in and out of Bitcoin, and they don't want to go back into dollar deposits, so they want something equivalent to dollar deposits, so they go into stablecoins. Then it's banking the underbanked. You have some people in developing countries that do not have a bank account, or poor people in the US that do not have a bank account, and they like to have a stablecoin. I think that use case is very much overrated. I think it's very small. I spoke yesterday to Ivan. He's the waiter from the Philippines at the restaurant we attended, and I asked him how he does his remittance transfers back to the Philippines, and he does not use stablecoins. He uses an app which is similar to Revolut. Yeah, so there's no need for stablecoins to bank the underbanked. Yeah, and the third big use case for stablecoins is illicit transactions. And I think people who want to do those illicit transactions, they like to have dollars mainly. I mean, think of the James Bond movie. You know, when the guy flew into the middle of Africa to recover all those bills. Those were not euro bills; were dollar bills. Yeah, and also the crypto assets are all denominated in dollars. So people want to trade in and out of bitcoins. They don't want euros; they want dollars. Yeah. So the main user groups for stablecoins want dollars, and this is why it's really not an issue for the euro area. So opportunities and threats from stablecoins. I mean, stablecoins are basically a money market share that pays no interest. So the biggest stablecoin out there is Tether, has a market cap of 177 billion, earns interest of around 4% per year. That gives it 7 billion. So the main shareholder of Tether, he sits somewhere in the south of France, and he collects 7 billion per year. Yeah, so that's the use case for stablecoins, and with that money, you can influence a lot of lawmakers in the U.S. to prevent CBDCs. Yeah, so that is stablecoins, and you know, there is now discussion in the U.S. Senate Banking Committee to allow stablecoins to pay interest. They are not supposed to be called interest because interests are unlawful under Section 4 of the Genius Act. They're called rewards. Yeah, which is like Sukuk. You know, Sukuk also doesn't pay interest, but so they're going to split the rewards in three. A third stays with the issuer, a third goes to the exchange, Ethereum, and a third goes to the holder. I just don't think this is very attractive. And I think this is also why stablecoins are just not growing anymore, because any sensible person that has money on deposit wants to earn an interest, and you're not going to earn anything on stablecoins. Now, what is the problem with stablecoins? They're not stable, as Megan just said. And the prime example is Circle, that traded at 87 cents on the dollar in 2023. So it's a sunshine product. You know, right now everything's fine, but they're not under any obligation to redeem at par. There is no mechanism to ensure that they will redeem at par. They have no access to lender of last resort, and you know, they can trade anywhere. Yeah, so they're not really that stable, those stable coins. Now there is another problem of the stable coins related to Europe. Yeah, so Europe really is a sideshow for stable coins. We don't have any euro-denominated stable coins. Nobody in Europe needs stable coins, I would say. Yeah, however, there are multi-issuer stable coins, and Richard Portes, he put out a really nice paper on that, where he shows that, you know, when you have this multi-issuer stable coins, Europe could become the ATM of US holders of stablecoins. So imagine you have a multi-issuer stablecoin which has part of its reserves in euros and the other part in dollars. Yeah, and then they have a lot of outflows on the dollar side. Yeah, and they need to gain liquidity. They don't get that liquidity, but they have, and then they have access to the European money market. So they could actually, you know, redeem euros to satisfy the redemption requests. So that could lead to a situation where Europe really has zero advantage from stablecoins, but a potential cost associated to stablecoins, because we could become the ATM for US stablecoins, something that we should try to avoid. And I hope that the future vice president of the European Central Bank will, you know, do something about that. Yeah. Yeah. So here's a little overview of different forms of cash equivalents. And they show you, you know, why I totally agree with Megan that tokenized deposits are the future. And there's something more on the right-hand side, which is even more attractive than tokenized deposits. Yeah. So cash obviously has no return, but also has no counterparty risks. Banks deposits have a bit of a return, but they have counterparty risk in exchange. Stable coins have no return and they have counterparty risk. Yeah. So that already shows you, you know, what do you need that for? Yeah. It's really a very limited use case for stable coins. Now, tokenized deposits. Oh, sorry, there's a mistake on my slide. Tokenized deposits, on the other hand, they have liquidity, transferability, and they have return. Yeah. So the red one should actually be green. So tokenized deposits are, I think, a very good alternative to stablecoins. They have properties which stablecoins do not have. And the best thing out there really is tokenized money market funds. Yeah, which is something that some asset management companies will start to issue. So you will be able to invest in money market funds. They give you high liquidity, high transferability. They give you better return probably than a bank deposit, and zero counterparty risk, because you're going to be the ultimate holder of all those securities in there. So I think when I have this race that Megan described, you know, the hare is CBDC, the rabbit is the stable coins, the rhino is the tokenized deposit, and the elephant, yeah, is tokenized money market fund. And that's what we're going to bring to the market. So then finally, here's the answer to the question that Boris raised about the future of finance. I do think that we're moving into a different world with the new technological innovations that we have. We can call that Web 3.0. So we start with a world where we're using the internet only to write. Currently, we're in a world we use the internet to write and read. Everybody can put up a blog and then, write something on Substack, yeah. And the third world we're moving into is one where we'll be using the internet to write, read, and execute, yeah. And all of that can be done with, digital assets. And I think tokenized deposits are the way forward. And Maria Luis Albuquerque, she agrees on that. For stablecoins is programmable payments. That's something actually quite interesting, that you make payments conditional on meeting certain requirements. For example, one thing that is very common in Germany, it's very un-German, but it's very common, yeah, is a fuel card would be to have a stable coin that actually only to the petrol station guard if, if the fuel card is presented and a little camera shows that actually it's the number plate of the company car, yeah, so that has been refueled. So, and you can think of many other ways of, programmable payments which combine certain conditions before a payment is released, and that can be done with stable coins. However, it can also be done with other forms of digital payment. So it's a good advantage, it's a nice innovation, but it's nothing really that is genuine to stable coins. Yeah? And then apart from that, I think stablecoins are of limited use. It's not going to be a big thing. Multi-issue stable, nobody releases them. Yeah, and this opens, an opportunity to Europe. European financial institutions can bank on tokenized deposits and CBDCs, and then thereby, basically forge the future of finance. Yeah. Thank you.
Thank you, Chris. Okay. So far, 2 votes for tokenized deposits around the table. David was neutral on that. Brunello.
Thank you very much. Yes, I also have a quick presentation to answer your question.
No, but make it short.
Yes, it will be short. And so, because the point here is trying to see stablecoins from a macro perspective, a geopolitical perspective, so top down rather than bottom up. If you continue looking at these things bottom up, you will continue be dragged down in the discussion about use cases and so on. I think is kind of just a partial way of looking at things. So let's start from a very top level and build up the argument in a stack that will be hopefully clear as I go by. So spheres of influence. The world is polarized. These are the countries of the Belt and Road Initiative, BRICS, and countries in which you can use the Chinese CBDC. As you can see, it's pretty big. This is 50% of world GDP, 75% of world population, 155 countries out of 195 in the world. Is big. This is what we call the rest. So the rest of what? Is the rest of the West. What's the West? The West is this one. These are the blue countries in which AI technology of the latest nature in the US can be used freely, okay? So as you can see, these are 2 equivalent maps. This is effectively the same map, but starting from very different perspective. One is Belt and Road Initiative, BRICS, and CBDC. This one is the use of AI, which is only free in North America, Western Europe, Australia, New Zealand, Japan, South Korea. That's it. That's the West. All the rest is, in fact, Chinese. What about Europe? Well, Europe is not strategically autonomous. They are aiming for that. And the problem is very well described in this map, where we can show that the only pan-European credit card circuits are, in fact, American. So we need to change that 25 years after creating the euro. First point. Second, energy production. The largest oil producer in the world is the US. They have the largest oil reserves, as we know. This is Venezuela, Saudi Arabia, and so on, but they are the largest oil producers. Who's the largest electricity producer in the world? That's China. As you can see, they have been skyrocketing over the last few years. In fact, they produce 40% electricity more than the US and Europe combined. In fact, and mostly come from now renewable sources. In fact, according to this EMBA study, all the new demand for electricity last year was met by renewable sources. So solar, wind, hydro, nuclear, and so on. So effectively, what we are seeing, if we put all these things together, is that two models in a polarized world, the West and the rest, let's say US and China, one based on a petrostate, if you want. Shale oil and gas put the US on the top of the oil production in the world, versus China that produce most electricity in the world. We can call it kind of an electrostate in China versus a petrostate in the US. And there's an open competition at global level on who's gonna eventually prevail. What do you do with all this electricity? Not a dangerous conspiracy communist, but Elon Musk said that electricity output is the single best proxy for industrial capacity. We know that. In fact, Chinese industrial production is larger than that of the US, Germany, and India combined. What do they do with this electricity? Yes, industrial capacity for sure, but also they power a massive high-speed railways and the entire ecosystem that goes around it. You see how fast it grew from 2008 to 2020. In 12 years, they went from nothing to this, okay? Sometimes I take a sailor from New York to Washington. It's not exactly that experience. They also produce electrical vehicles, much more than any other country in the world. You see, you can think that EU and China are the same, but look better at the scale. So China is in the 12 million, EU is in the 2 million phase. So is just another level. How this relates to digital currencies? Well, the linking point, as I was saying before, is the Belt and Road Initiative. This was launched immediately by Xi Jinping as soon as he was elected. But the day after launching the Belt and Road Initiative, he also launched the CBDC project. He knew that eventually he would need to go there. And in 2015, he launched effectively the three fronts of the tech war: the Digital Silk Road, which is the digital equivalent of the Belt and Road Initiative, the Made in China 2025, and CIPS. Now, Catherine has spoken extensively about CIPS, so I don't need to say much more. Just want to say one thing. Belt and Road has moved from the first phase, building bridges, ports, railways, and so on, into exporting Chinese electrical production, in particular, solar panels, production, and the software that goes with it. Actually, hardware and software. The hardware is the inverter, AC/DC, and the software is the one that allows that to happen. This is effectively a Chinese monopoly that is everywhere. In fact, is also in the US. NERC, the North American Reliability Electrical Company, has actually found that most of their software is, in fact, made in China. So China is exporting lots of things, including electricity production. This is the CIPS. As I said before, has grown quite a bit, but is everywhere, but especially in the countries of the Belt and Road Initiative. So all this serves the purpose of de-dollarizing the global economy, okay? So dollar as a reserve currency has been declining over the last few years from over 66% to around 58% these days. How are the US reacting to all this? They are reacting through stablecoins. So this is not a Trump fan. Paul Ryan sits on the other side, if you want, of the Republican Party. He's not MAGA. And this was published actually on the day of Trump's second election, 5th of November 2024, on Project Syndicate, not necessarily an outlet favorable to Trump. So even those who are not exactly Trumpian believe that the stablecoins will be the response to Chinese de-dollarization of the global economy. How do they do that? Let's look at SWIFT versus Tether. Now, SWIFT is in the blue countries, and in the green countries, this is not where it's not present. And again, Catherine did a tremendous job in describing what it is, how we got there. But look where Tether is mostly diffused. Guess what? Is exactly in those countries where SWIFT is not. So if you combine the two, effectively, this is a project of re-dollarizing the global economy. So in an equilibrium, you could think of a race between US and China, more particularly US stablecoins and Chinese CBDC. Now let's go to the recent events. We all know that Iran asked to pay a toll for the Strait of Hormuz. How would you pay the toll? Only three ways: ECNY, Bitcoin, and Tether. So clearly now the geopolitical component of these digital currencies is becoming evident or self-evident. And why is this happening? Let me borrow some of the concepts that Catherine discussed before. Here we need to re-anchor the dollar. Let's look at the anchors of the dollar over the last few years. Of course, we knew it was gold during the Bretton Woods period. Then war in Vietnam, lots of redemptions, people want gold back. In 71, Nixon said, sorry guys, it's not gonna happen. So there was the depeg from the dollar to the gold. We entered these periods that ended up with the first oil shock, which effectively was a way of the oil producing countries to say, hey, we are giving you good oil and you giving us, a very devalued dollar. So let's re-anchor this, okay? So they launched a double anchor, the fiscal anchor, dollar linked to the treasuries, and the petrodollar, effectively creating global demand for dollar to buy oil. What happened to these two anchors? Well, look at that. That's US debt over the last few years. It's increased exponentially under any administration. So, and the last hit, I would say, is the big, beautiful bill by Donald Trump that has effectively increased the US Treasury debt by 4 trillion over the next few years. So that anchor is almost, well, let's say undermined. But the petrodollar also has been undermined by the war in Iran because oil doesn't flow freely anymore. So what do they want to substitute these anchors with? My answer is going to be substituted by a new form of energy. And this new form of energy is data centers. Data centers compute all this industrial production that is used to produce AI and so forth. Most of them are in the US. And as you can see, they consume as much energy as large countries. You see here Italy, Australia, Spain, and so on. They are gigantic, like as big as 130 football pitches put together. Some of them are in the Middle East, in the countries that, in fact, hosted some of them, and that's the reason the retaliation of Iran was mostly against the data centers of US companies in the Middle East, not the US bases, because that was a way of attacking the new anchor of the dollar. So, but what is compute? Let's ask the biggest of all, NVIDIA. What is compute? Compute is nothing but a very sophisticated version of energy. In this 5-layer cake, you see that NVIDIA technology and effectively hardware is nothing but a repeated sophistication of underlying energy. So eventually, this battle between the US stablecoin and Chinese CBDC becomes a battle between the new petrodollar, which is effectively a stablecoin compute, versus the electro yuan. What about Bitcoin? And this is to answer a question to some of you that have asked repeatedly during these days. What is it doing in all this? Well, are we sure it's a two-way race? No, it could be a three-way race. Why? Because Bitcoin uses much energy as a large country, say Poland, to be produced. For many years, we have considered this as being a negative externality of the production of Bitcoin. That's wrong. This, in fact, is the value of Bitcoin. The value of Bitcoin is the value of the energy used to produce it. It's the value of the integrity of the blockchain, the fact that it's immutable and trustworthy. So eventually, you're going to have a three-way race between petrodollar in the new form of USD stablecoin compute based on fossil fuels in the US, the electro yuan based on mostly renewable and the electrical grid that runs of it, and the Bitcoin that through its proof of work is one of the few that still does it, so lots of energy consumption still preserve value. And therefore, in the future, it's going to be a three-way race, in my view, between US stablecoins, Chinese CBDC, and the Bitcoin. And if that makes any sense, the answer to your question, Boris, is I think what Scott Bessent said might be even an underestimation of where the stablecoins can actually be, much larger than we actually believe at the moment. Thank you.
Okay. Thank you, Brunello. Yeah. So we're going now to Chris. You've heard everything, and you decide where to start from.
Yeah, a lot of stuff said here so far. And I have to say, of course, whatever I say are my views, and I guarantee you my colleagues will tell you that too. These are his views. So on stable coins, I've always just looked at stable coins as it's just a payment instrument. There's nothing evil about it. There's nothing dangerous about it. It's a way in which you can conduct transactions and use it as a payment. Now, what's interesting, it's created in DeFi, and it was created in DeFi to serve as a medium of exchange. Even the Bitcoin bros who thought Bitcoin would be the currency is not used for payments. People buy Bitcoin using stable coins, but they don't use Bitcoin to buy other stuff. Now, it works amazingly well in the Bitcoin world. It has no regulation. There has no sovereign behind it other than they're pegging it to $1 and promising to give you $1 if you want it back. So it's amazing. Unstable, it immediately repegs because people believe it's going to be backed and redeemed. So try that with some other currencies that depeg and see how fast they return back to their peg, run by sovereigns. So this is just kind of a silly argument that it's unstable compared to other currencies in the world. Now, what stablecoins bring, and everybody gets caught up in the stablecoin, but what it brings are crypto rails into the payment system. It's a different way that some object can transfer across individuals without having to go through the banks, go through Visa, go through MasterCard. That, to me, is pure competition. There is now a new set of rails that you can bypass these monopoly-type networks to make payments. So for me, it's bringing competition into the payments world. Now, it may never have a big footprint in terms of being used, particularly in retail, but it's a competitive threat to everybody else to keep prices and costs down. That's all we care about as economists. I don't really care what the actual object is. Now, I will tell you that these things are used for cross-border payments, and they are scaring the banks. If you think banks don't think this is a threat, then why are they lobbying so hard to stop it? Why would you waste resources politically over and over lobbying if you didn't think this was actually a serious threat to your income, your resources, or whatever? You're just being dumb if you're doing that. So they view it as a serious competitive threat in the payments landscape. Now, whether you and I buy a stable coin and use it to pay is also irrelevant. You go through an intermediary to make a cross-border payment. You don't know how that thing is done when you go to a bank, when you go to total space. If you go to something like Wise, you don't know how it's done in the background as a business or a consumer or whatever. You just know that you give them the money and it came out the other end. That's where blockchains and stablecoins get used. It's the way that the intermediaries transfer money around the world, and they can do it very fast and very cheap, and you don't even know it, right? So that's my point. It doesn't require me to have a wallet with a lot of stuff. It just requires the intermediaries doing the payments to be able to move it on these rails. Now, what I also find fascinating, given the discussion we had yesterday about when we talked about private credit, this is an interesting case where some financial instrument in the shadow financial sector wants to come in and be regulated. Usually everything goes the other way. Something that's regulated is trying to get out of the regulated sector and get into the shadow. This is just the reverse. Stablecoin issuers, circling, they want to come in. They're happy to be regulated. They're happy to be following the rules. That's the whole point of the Genius Act, was to say, here are the rules, come on in and abide by those rules, and you can operate. Now, do these things bring risk of illicit finance, tax evasion? Yes, of course, any currency does. If that's the case and you're really worried, stop printing currency. Ken Rogoff has been saying this forever, but no central bank will. So you're accepting some degree of illicit finance, tax evasion, money laundering, whatever, by not getting rid of your own currencies. So if it brings that, should we ban it? No, it's a benefit cost calculation, right? Yeah, there's going to be some potential cost to doing this stuff. Let me give you an example I've been using. AI, does it bring greater risk of fraud into the payments world? Absolutely it does. Everybody's worried about the potential fraud from AI. Is anybody calling for banning AI because of that? No, you're just going to have to figure out how to deal with it. So the critical thing for me is there a new payment innovation. Don't kill it before we see what it can do by over-regulating it. Now, are these things a threat to U.S. monetary sovereignty? No, they're going to expand it. I believe in the same view that Besson has on this, which is stablecoins are going to broaden. And it's going to be like a fixed exchange. Countries that adopt it, it's like a fixed exchange rate system. You are going to import U.S. monetary policy. So it's broadening the reach of U.S. monetary policy to countries that use more stablecoins. Now, should we ban stablecoins because countries with bad banking systems and unstable financial regimes and lots of financial repression, so that I can continue to support that? It's not my problem. You got a bad banking system, that's your problem. It's not my job to protect you from any kind of outside threat. So it's a discipline on other countries to have better banking and financial systems. Now, one other thing is, I guess one of the key questions here is, does it affect U.S. monetary policy? I would say no. I don't look at the money supply measures when I sit down at an FOMC meeting and say, should I raise or lower interest rates? I have no idea what these numbers are. We don't look at it. It doesn't matter, unless you're Switzerland and Germany, the ones who still do. How payments are made over what rails does not enter into monetary policy discussion. And let me give you from the academic literature, what's the main macro model that we use for all kinds of policy analysis? It's a standard new Keynesian model. Where's the payment instrument in that model? None. There's no payment instrument. There's no way that, nothing is said about how payments are getting made, but we set policy completely independent in all of our theoretical models without having a clue what's doing all the payments for transactions in those worlds. And then the last thing I just want to make, there's this myth that these things are going to disintermediate the banking system. This is nonsense. They can't. It's a closed system. When I go to the grocery store and I buy an apple, money goes out of my bank account into the grocery store. So my bank, yes, my bank lost deposits, but the grocery store's bank received deposits. The same thing is true with a stable coin. If I go buy a stable coin, I give it a claim on my bank account. They give me a stable coin. What do they do with the claim on my bank account? It only has value if you do what? Bring it back into the banking system. It's not a hand-to-hand bearer instrument that you can go use like currency. It's a claim on my checking account or my bank account. So this stuff has to come back to have any value. So this is just a myth that it's going to demystify or disintermediate the banks. It just can't. It's a closed system. The only way you can have these things leave is through convert it into real currency. You go to the bank, say, I want paper currency. That will disintermediate the banks. You put it in reserves of the central bank. That will disintermediate the banks. Or you put it, for us, you put it in the Treasury's checking account, the TGA. That goes out of the banking system. That's the only way that this stuff can leave. Now, if the banks want to shrink their balance sheets, they're more than welcome to, or that, but it's nothing to do with stablecoins. This is just a big myth that this is going to do this. So I'll stop ranting.
Great. Thanks a lot. Interesting. I will open immediately now for the questions. I have my own, but I'm sure there are many there. Okay, so let's start here, and then we're going to go to the right. I have 4 for now. Yeah, Marcel.
Thanks so much. This fascinating panel, and we can't comment on everything. So let me just comment on the notion that the role of the dollar is in this danger of disappear, of being really hurt. I mean, and I was a little bit part of the politics of BRICS, just for a little bit of time. And there's no way any Chinese instrument is going to substitute the dollar if the renminbi is not fully convertible, period. So that's fantasy. I mean, and if you look at the decline of reserves in dollars, that has been more than compensated by a big increase in demand from the private sector. So the US is this big balance sheet absorber of the world with this big demand for many different types of US assets, which, by the way, this administration has been complaining and blaming that aspect of it for the high value of the dollar and all the way they look that is upside down. So I'm not saying that the dollar is like immune to policy and that I do not get concerned about the weaponization of the dollar and all that, that's fair. But the idea that there is an actual alternative to the dollar, even in our foreseeable future, it's fantasy, I think. But anyway, so that's just a comment, and I'd like to have a...
Thank you, Era.
Thanks, so very interesting. So I'm going to talk about a slightly different use case, which is on the fiscal side of things. I mean, stablecoins are seen as sort of creating a relatively price-insensitive demand for short-term treasury bills. And that from a demand management perspective, that makes sense. I mean, you could say, okay, this is useful, but then it also creates rollover risks. I mean, there's, you know, and it changes the way the yield curve looks and sort of shortens the maturity of US debt. And so debt levels are high, we're shortening the maturity. Stable coins, are they playing a role or not? Or would they play a role or not? So I would like to pose that question to the panel. Thanks.
Thank you, Ricardo. And then, yeah, then it's going to be you.
I like I like the panel to comment on two things. A Chicago economist, Luigi Zingales, interviewed the father of modern finance, Eugene Fama, a few months ago. And the question was, what is going to happen to Bitcoin within the next 10 years? And Fama replied that he thought that the probability of Bitcoin going to zero is close to 100%. This is the first thing I would like you to comment. And the second is some of you are familiar with the 1933 Chicago proposal, Henry Simons and others, of the narrow banking that finally did materialize. And my question to the panel, isn't it the case that belatedly stable coins are the narrow banking proposal of Henry Simon?
Okay. Thank you.
Hi, everybody. I have a question about coexistence of CBDCs and the banks. So before I ask, just a disclaimer, I'm just an intern and this is my first conference. So if it's a stupid question, just ignore it.
No,
okay?
that's encouraged.
So yeah, anyway, so I think, let's say if we introduce CBDCs, I think it's just going to be a matter of time before people start asking the question, how come is it that banks get paid to keep their money at the central bank and people don't, right? So then it will be up to the central bank to justify why is it that when a bank has a deposit at the central bank, they get paid the deposit rate, but private citizens don't. So my first question is how you would justify this. Now, my second question is, let's say some populist party gets into power and they decide that private citizens have to get paid a deposit rate equal to the same rate that the banks get paid when they keep their deposits at the central bank. In this world, why would anyone still have a deposit with a retail bank and not at the central bank? Because the central bank deposit, the CBDC, is 100% safe and they still get a return on it. So how do you see then the existence of banks in this context of CBDCs? Thank you.
Thank you. And one more here, then we're going to have a second round, or maybe we take this first, and then we have already two for the second round. No, but let's wait now. So, David, who wants to pick?
Sure,
What?
Well, I'll answer let me try the dumb question, which isn't dumb at all.
No.
It's a very good question. The last question you asked was, I think, you asked how retail banks would compete against an interest-bearing CBDC. Very easily. They'll raise the deposit rates to retain their deposit funding. It'll cut into their profit margins, of course, but I think that they'll do whatever they can to retain the lowest cost funding that they have available. And in fact, people have advocated or suggested that that might very well happen. Just very quickly for Ricardo, Bitcoin, FAMA, who listens to what FAMA has to say anymore? Bitcoin going to zero, I mean, is a perfectly legitimate bubble asset. It's not going anywhere. Chicago plan, the stable coins being kind of the manifestation of the Chicago plan, not quite, almost. A full manifestation of that would have seen, grant the stable coins Fed master accounts, 100% reserves, and then prohibit the commercial banks from issuing deposit liabilities. That's not going to happen. In fact, it's going to be the opposite way, as Megan and others have pointed out, where you're going to see tokenized deposits possibly crowd out the stable coins.
Thank you. Megan.
Yeah, I'll just pick a few of these. On the dollar as a reserve currency, I agree there isn't really an alternative and probably won't be in my lifetime, I don't think. This question about banks and a central bank digital currency coexisting, I think is a great one. I agree with David. Banks will just increase their deposit rates. But of course, banks don't just have a deposit base. They also lend. That's the other half of kind of their money-making model, to simplify it. And I can say as a central banker, I have no idea how to do a know your customer analysis or anti-money laundering analysis. I don't know how to evaluate loans in the same way that people who do that for their main jobs do. So banks will still have a function, I think, beyond just having a deposit base. I think Bitcoin is a bit like tulips. So I think it's a very effective security, but not as effective as an actual currency. So I think it will continue to exist as a security that you can dip in and out of depending on your risk tolerance. So I think it will stick around. I just don't think of it as a currency. It doesn't have a lot of moneyness to me. And the question about stablecoins financing U.S. Treasuries, I guess you're asking, does that increase or decrease risk? I think you're right. That these stablecoins are backed by short-term government debt, so T-bills, and that does reduce the average maturity for treasuries, and so there is a rollover risk. When will that become a problem? I can't tell you. The U.S. Treasury market is the biggest, most liquid market in the world, so I think it might take a while. But I do think that does increase the risk.
Thanks. Chris?
Yeah, I'd just like to comment on the last question, and then could I also comment on Chris Waller?
Yeah, you can comment also on Chris Waller, but there was Marcelo also telling you. No, to Brunello. Sorry.
That's right.
It's for Brunello.
So on the last question, you had two questions. No, your first question was, how do you justify that CBDCs are not interest-bearing? And your second question is, if you give non-banks access to the central bank deposit facility, why would anyone hold deposits at a commercial bank? No. And I think your second question is the answer to the first question. No. So it's precisely because if you give non-banks access to the deposit window, nobody would hold any money at a commercial bank. This is precisely why you cannot allow CBDCs to be interest-bearing. Yeah, they cannot compete with deposits. And CBDCs are dangerous because they introduce a lot of volatility on the liability side of commercial banks. And this is why they're going to be capped at 3,000 euros in Europe. And if I could just comment briefly on Chris Waller. So, Chris, you said that there can be the stablecoins can be a competitive threat to banks, and they can be discipline on other countries. I can't think of any asset class with a 300 billion market cap that can fulfill those functions. They're just too small, to be a threat to anyone. And then you said that, stablecoin issuers want to be regulated. Well, Tether, they hold 10% of their assets in gold and in Bitcoins. They precisely want to be unregulated. This is why they're offshore. This is why they're in El Salvador. And then you say that it's silly to argue that stablecoins are unstable relative to other currencies. Well, stablecoins are like a money market funds. And as we know, money market funds can break the buck. Yeah. So
they don't promise a return.
Yeah, but a money market fund is less stable than a bank deposits. No, I would think that is the case.
Okay, we have a two-hander by David here.
Yeah. So
Brunello, wait a little bit. Just we have a two-hander on Chris.
I'm sorry, Brunello, but I just have to push back on Chris's comments. The alleged instability of money market funds. Be careful, Chris. The primary reserve suffered problems in 2008, but that was a prime institutional fund. And yes, we can learn lessons from that. But the government money funds were quite resilient at the time. And the Genius and MiCA compliant stable coins are going to be more like government money funds that show that resilience. So I don't accept that claim that you make about the inherent instability of at least these MiCA and Genius Act compliant funds. Tether is another animal, but I did discuss that at length. In regard to what you say about the payment of interest on CBDC, I know of no economic model that suggests the claim that you just made, that it's necessary that CBDC pay zero interest. And I do not understand the Genius Act restriction, the Regulation Q type restriction it imposes on stable coins. I mean, this is a restriction that we imposed on commercial banks back in the day that we removed, and I argue that it had benefits. So anyways, I thought I would just push back a little bit there, just to add a little bit of spice.
You want to respond, Chris? Quickly, shortly? No. Brunello.
Yes, thank you. So I'd like to take some of the questions. First of all, Marcello. So if my slide, the first slide, proves anything, is that the world is polarizing, okay? So you need to think in a world in which China has its own web, it's not worldwide anymore. China will have its own satellites, everybody will have his own internet, and it will be not necessarily interoperable. This is not good news for us, but that's the world we are headed, okay? So China has tried to internationalize the renminbi for quite some time without any success. Why? Because in order to have a good global reserve currency, you need to run a current account deficit, so the currency goes out, and an open capital account so that you can, transform it anytime on request. China doesn't want to do either, right? It doesn't want to run a current account deficit. It wants to close capital account, otherwise there will be capital flights, right? So that model didn't work. That's why they resorted to the electro-state. So they have a completely new model based on digital currencies in which this is going to be a closed system for them and their countries, that they don't plan to de-dollarize the West, so to speak. That's for the US, okay? They run on all other countries, Africa, Latin America, Middle East, if they can, and so on and so forth. So let's not think about a competition between one versus the other. They will be at the same time, as I said before in my slide, maybe a three-way race. In fact, that allows me to answer the question by Ricardo on the Bitcoin. It's not going to go to zero. Let me tell you, it's not going to go to zero. It had many chances to go to zero, and it keeps on going up. In fact, is deflationary. You need to think as Bitcoin as tokenized energy. Tokenized energy can go hand to hand and is not inflatable, okay? Actually, it's deflationary. Since it's capped at 21 million, it will only increase over time, okay? So it's not going to go to zero anytime soon. On the fiscal, yes, you're right. Clearly, Scott Bessent saw an opportunity of financing the big, beautiful bill with the new buyer of treasuries, of course, increasing the rollover risk, as you suggest. But that's a price well worth paying, considering that the volatility that we saw in treasury market when the big, beautiful bill was, in fact, approved. On the coexistence between CBDCs and banks, guys, sorry. Let's consider the words central bank digital currency. Central bank, okay? Which is the bank or the banks. Secondary objective of all central banks is financial stability. We are going to have the champion of financial stability as of tomorrow, okay? Here. Okay, do you think that they want to create financial instability by disintermediating banks? Of course not. So it's not going to be one versus the other. This is a one-tier system that nobody is talking about. It's going to be a two-tier system. The liability is of the central bank, but the wallets, the digital wallets, will be issued by commercial banks. And so the question for commercial banks is how to make money in the new world. Can they continue to make money by organizing the payment system? No, because Bitcoin has proved that to move money, you don't need to spend that much money. Okay? So abandon the old revenue line on payments, in particular cross-border, focus on something else in digital finance. I mean, Chris said it very well. Web 3.0 is read, write, own, if I may say, rather than execute, read, write, own. And so the banks will be at the core of that. In doing what? Issuing digital wallets, having custody, exploiting on-chain lending opportunities, and issuing their own stablecoins, alone or in consortium as with Kivali. So there will be plenty of new revenue lines if they know how to execute it, which is the reason why, as Chris said, they've been campaigning so hard against against stablecoins, because they see it as a threat. But they see it as a threat because they think with their eyes on the reverse mirror, right? Instead of looking ahead, the future of the profits that they can make if they embrace the digital revolution, something they haven't done so far.
Thanks, Chris.
Yeah, I'll just touch on a few things. So, Ricardo, I think what's fascinating about what we're seeing now is for the first time in centuries that you're able to split the payment system off from the banking system. That's it. I mean, that is a new world that we haven't, and that's kind of what the narrow banking, that's the basic genesis of the idea. Split the payment system away from the credit risk aspect of banking. But we've never seen it. So we're now in a situation where we have firms that can do all this type of payments with stable coins, and it's completely outside of the banking system. And like I said, there's nothing evil about it. It's just you're not going through the banking system. So I think I don't like calling them narrow banks. They're just non-bank payment firms that do this. On the fiscal stuff, it's going to hinge on whether they want to meet the demand by issuing more treasuries, or they just let the price get bid up and the yield goes way down. It's up to whatever treasury wants to do on that. I want to touch on this Bitcoin thing. Bitcoin is not a currency. The crypto people don't even use it as a currency. It's electronic gold. It's the best description I can think. It's a commodity. They buy it, they hold it, they hope it goes up in value. Maybe it doesn't. I consider Bitcoin kind of like baseball cards in the US. They don't really generate anything, but you buy them and hope they might go up in value. Couple last things. CBDCs. Good God. I gave a speech on this 5 years ago when this was the rage in central banks, which was to come up to create a central bank digital currency. And I asked one simple question. What is the major failure in the global or US payment system that requires a CBDC and only a CBDC to fix? You can't answer that question with a CBDC. There is no good answer to this. And that's why since I gave that speech in August of 2021, almost every major central bank in the world has just stopped. They just can't find a reason for this, the solution in search of a problem. So the idea that somehow it's the US Senate and the crypto guys, no, we stopped. We had no interest in working on this thing because it wasn't going to fix anything. So this thing, only the European, only the ECB and the Chinese. Two banks.
Well,
And nobody in China uses the thing anyway. They like WhatsApp and Alipay. They don't even use this stupid thing. They couldn't even get it through the Olympics to get people to use it. Jeez. And then last thing, I'm really still not clear what the big value of tokenized deposit is. Tokenized deposit means you can go trade stuff on a blockchain. What's the big advantage on the blockchain? 24/7 trading. You can do that now on FedNow. You can do that on TIPS. You can do that on RTP, which is the private sector real time. They run 24/7. So you can do payments and they're very cheap. Programmability, smart contracts, that's again, this is one thing that was said. They're not unique to stablecoins. Smart contracts can be run on any payment system. So I personally don't see the big advantage of a tokenized deposit world when you can already do 24/7 payments very cheaply, as Marcelo was talking about PIX in Brazil. I mean, you can already do it. That's coming, my friend. Once you start linking these into real-time payments, that's down the road. I'm not saying when or how, but that will eventually start happening. So I'm not as convinced that the tokenized deposits are going to be the thing that, is the miracle payment solution for all things. Since again, it's already available. The biggest problem we have with these real-time payments, we don't connect to every single bank. And that's kind of where the potential problem comes in. So, but that'll get fixed over time. Eventually they will. And then once we do any kind of bank or inner payment systems, which have more about governance, not technology. I just don't see what you're getting with tokenized deposits.
Very good. Now we have an interesting discussion. So, Megan. No,
Yeah.
well, let me just say that I know exactly where Chris thinks that the baseball cards price will go soon. So,
Yeah.
Go on, Megan.
Yeah, just to push back on this tokenized deposits thing. That's why I started my first intervention by saying, what's the point of this? And the point isn't just payments. It's about smart contracts. And so, you can't currently have tokenized securities that automatically transact off the back of a delivery of something the way that you can with tokenized deposits. So we don't have the system for that. You do need a tokenized asset with some kind of ability to embed it with a contract. So you can't do that with the Fed now system. It just doesn't exist.
No, but we can't. We've already experimented with how to. All the smart contract is a different messaging system. That's all it is. And it can be executed on our payment systems just like anybody else. We haven't done it yet because there's really no demand for it at this point in time. But technologically, it's not a problem. It's just a different messaging system. It has to have certain things executed at a point in time. That's it. It's not that complicated.
But it's messaging and execution. I think that's the crucial bit.
And the tokenized deposits are also going to be issued by, commercial banks and that fall under a different regulatory umbrella than stablecoins.
Yeah.
And I think a lot of multinational firms are likely to end up preferring kind of, they have relationships with banks already. Banks aren't just about payments. These big multinationals want to do business with these banks for a variety of reasons. And Chris, I'm not saying stablecoins will disappear, but I don't see them eating. I see a role for coexistence here.
very good. And Chris, you know that I would side with the David on that one. We had a discussion in Jackson Hole with Mickey and Pierre, and you know what? I would think the same. I would also go for the tokenized deposits team. Chris?
Yeah, no, I said that in my opening remarks. I don't know if stablecoins will ever have a big footprint, but we know this in economics that all you need is competition on the fringe to drive pricing. That's it. It doesn't have to be a big thing. And one other thing on the market cap, a lot of these stablecoin transactions, you mint it and burn it on the same transaction. It's not sitting in somebody's wallet. You mint it to run it over the rails. It comes off on a platform, it gets burned, and that's it. That helps speed, transmission, cost, everything. But it doesn't say anything about the market cap. It could be zero. It's just one-time payment object that goes in. That's it.
Chris? Yeah. No,
Thing. Sorry.
Chris first, and then
Sure.
Three brief comments. On the stablecoins, I really don't think this thing is going to take off. I think it's a strategic mistake by the U.S. administration to put all the emphasis on stablecoins instead of looking at the other forms of digital finance. I think it's snake oil. If you want to feed your citizens snake oil, go ahead, be our guest. Yeah, it's not going to lead you anywhere, I think. And I think you made a very strong comment, Chris. You said that digital finance will split the payment system from banks that are prone to credit risk. I think that's a very deep comment, and it raises the question: if that's really the case, if banks are no longer in the center of the payment system, if you split banking from banks, do you really need to protect banks in the same way you used to in the past? Yeah. So that, I think, raises a lot of questions for supervision and regulation. Do you really need the lender of last resort in the same amount that you used to use them in the past? And the last point I wanted to make is this question is, what is the market failure that the CBDCs are trying to address? Yeah. I mean, we discussed that here last year. Just a brief example. There is this German lady who works for an NGO called Hate Speech. Yeah. All she does is try to enforce European regulation. Yeah, she gets funding from NGOs for that. Yeah, she's been sanctioned by the U.S. government to the point that she can no longer buy a flight. Yeah, or rent a car because it's all done on Visa and MasterCard. Yeah, so the problem that we're trying to address here is an overreach of U.S. legislation or whatever executive power, that is weaponizing the US payment system to the detriment of European citizens. And we need to establish our own independent payment system and payment infrastructure to be independent of Visa and MasterCard and independent of the threat of US sanctions. The first best solution would be private solutions such as PayDirect. It failed. The second best solution is a CBDC.
And getting rid of NATO apparently is the next thing, right?
Well, that's what you're doing, no?
It's getting more and more interesting. Wait a little bit, Marcelo. This is the panel you want to have. Now, Brunello, yeah.
Let me throw another. Let me throw in another thing. What's the biggest thing we have in front of us these days? AI, right? Okay, AI these days is AI agents. AI agents do what? They do virtually everything. Okay, there's one thing they cannot do: buy stuff. As of now, as of tomorrow, actually as of yesterday, to be honest, but as of tomorrow, they will. How they're gonna buy stuff? Well, there's a protocol that links AI agents with the payment system, X402, for example, by Coinbase, there are many others. And what is the payment asset that they end up with? There are effectively only two: CBDCs, so a central bank settlement asset, obviously, or way more likely, stable coins, in fact. So all AI agents in the world will use stable coins for their transaction. They are not going to be given a credit card number. They are not going to be given a tokenized deposit. They may, but most likely they will be stable coins. So in the future, stable coins will have their obvious use by AI agents that will be everywhere, doing most of our jobs, in fact.
Thanks. Marcelo now. And then, no, you first, and then Marcelo. You have a microphone. So.
Exactly, I have the mic already. I have to brief personal confession up front, right? I have to say that I've enjoyed this entire conference, even though this is a conference with probably the highest opportunity cost that I've ever been to. Just have to look outside of the window. But even by the high standards of this conference, this panel has been totally fascinating, really, and it will take me a while to digest all the divergent views and thought-provoking views. I actually had a question for Chris Kopf, but partially you have answered it now. You portrayed CBDCs as the only rational way forward. Do you have any other argument apart from the one that you just put forward, which I don't believe you mean seriously, because this is not really a systemic argument in favor of central bank digital currency, and certainly not if you think as an economist in cost-benefit terms, right? I mean, to argue this project, that has cost so much and still will cost so much. I'm talking about the digital euro, and I have to say, I come from an institution that is a very strong proponent of the digital euro. So I'm certainly not talking on behalf of my institution here, but do you have any other argument? And also, given this entire ecosystem that we have just heard about and the large number of competitors that central bank digital currency will have to face, how will it be in the position to keep up with that competition? And does it necessarily have to be provided by the public sector, since there are so many private sector alternatives, right? And to come back to what Christopher Boris said, all the Western central banks have pulled back, right, or have backpedaled actually on their digital currency projects, and those countries which do already have it, the level of acceptance is rather low. So how would you convince someone like me, who has really tried for years to understand the reasoning for a digital euro, that this is the rational way forward and something that we really need and is worth the cost that we are paying for it? Thank you.
Thank you. Let me just correct you. There are 21 Western central banks that have decided to go with the CBDC, so it's not only one. It's Vedran first, then Marcelo. We don't hear you.
Okay, I'm on. So the topic is stable coins and monetary policy, and we kind of drifted away from stable coins, and we never even got to monetary policy. So I would try to steer the discussion a little bit back to the topic. There was a lot of discussion about positive interest rates, and Chris Kopf said that the stablecoin issuers are a little bit like glorified money market funds that pay no interest. Well, actually, it's more. To me, we have institution like that, and it's called the central bank. Central bank does not pay interest on at least a part of their liabilities. So, and coming from a central bank, I still remember that when we had to endure the period of negative interest rates. And so I'm wondering what happens if we go back to a prolonged period of negative interest rates. What happens with the stablecoin issuers? I mean, we can work with negative capital. I mean, Fed has the huge deferred asset account. I'm not sure what would happen with the stablecoin issuer if it would put in the assets, the item deferred assets, $100 billion. I don't think it would survive very long. I mean, it's not because of negative rates, of course, I understand that, but and even in case someone decides that it's not wise to operate with negative capital, we have examples of central banks that are being recapitalized with public money. For example, Riksbank received quite substantial injection of capital from the treasury. So, I mean, we are there is an inherent risk from negative rates. So I wonder what you think if rates go into the negative territory, what happens with the stablecoin issuers, whether it will annihilate them completely or they disappear or they can survive this natural disaster for them. Thank you.
Thank you. Marcel?
Chris, you went back to the debate we had last year. Always when someone say, I don't know why you'd have CBDC, you talk about payment system. You do not need a CBDC for that. You do not. So, and I gave, it was exactly, look at PIX. Why is the US government mad at PIX? Because PIX insulates the Brazilian payment system from MasterCard and Visa. So you need a payment system that is more efficient, fully electronic, and integrate the euro area. The CBDC, I'm not particularly against, but it's not the currency part that is really that you are claiming. You like to have that payment system. And it seems to me that the digital euro is a way to get the payment system in some sense, from the back door. And that's why the window, you cap at 3,000 for people to claim the liability, go directly to the central bank, exactly because you're trying to minimize risks of financial stability and all that. Actually, I would claim they should make that window €1 or something like that, very small. But you have the whole infrastructure put together, so you have a payment system that does not depend on the large American credit card companies. Again, it's not the currency aspect. I agree with it. I don't see the value of the currency aspect, but I do see the value of a better payment system. Yeah.
Yeah, it's in the means of payment. Okay, let me stop here and go back to the panel. Who wants to? Chris, do you want to start first now, and we go from you here? Chris, you want to start first now?
No.
No.
I don't really I think I've said everything I need to say. I don't really have anything else to say.
Okay. Brunello, on any of these issues?
Yeah, very quickly on negative rates. And again, I think Megan said it very clearly. You can't say digital euro without saying strategic autonomy at the same time. So the answer to the question why is purely geopolitical. Full stop. Let's not pretend it's a settlement. No. The way you gain strategic autonomy is by printing your own money. Because if you go in the nitty-gritty of the transactions on chain, Chris said very well, you mint, you burned. The on-chain transaction can be done in Europe, okay? The part that is on-chain with USD stablecoins. It starts at euro in Germany, ends in Europe in France, but the on-chain transaction is in US stablecoins. You cannot possibly want that if you are if you want to have strategic autonomy. Full stop. That's the reason. There's nothing else. That's why the geopolitical. That's why I brought this new viewpoint, if I may, on negative rates. CBDCs, in fact, can enable negative rates, actually can enable severely negative rates. The only reason why we didn't go more negative with rates in Europe is because there is still cash. So you can withdraw cash from your deposit where you're paying the deposit rate, the negative one, right? And store it in a vault. And so that constraint in how much you can actually lower the interest rate into negative territory. But the less cash is used, the more negative you can go. And so actually CBDC can enable severely negative interest rates, which could be a solution to the next crisis if they ever emerge. What happens to stablecoin? I don't care. They will need to figure that out. Hopefully they made enough money to withstand those periods. That's it.
And stablecoins are going to make sure they don't do that.
Well, let me add another aspect to that you just commented. So imagine the stable coins really grow, okay, and doesn't that strengthen the zero lower bound on monetary policy, because they are redeemable at par, they have to be covered by the high liquid assets, and they don't carry interest rates. So more they grow, more of the zero lower bound goes up. So higher the probability you go to the negative interest rates, which then I mean the dynamics is interesting, I think, if you think about it.
Yeah, I mean, so, you take Brunello's argument with currency. All right, I can take all my money and put it in currency, and then I got to put it somewhere physically. And it's got to be safe, and it's got to be secure, and I got to worry about somebody breaking into my house and stealing it. That's the beauty of stablecoins. I mean, they're pretty much unseizable unless somebody really hacks into your account somehow and gets your identity key. And you can do huge quantities with zero storage cost. So that's what I'm saying, that stablecoins are going to kill this idea of central banks imposing negative interest rates unless you ban stablecoins and somehow lock off people from getting on the internet.
Okay. Chris?
Yeah, first I'd like to thank the National Bank of Croatia and Boris for inviting me again to this conference. Just to say how this came about, yeah. When I started my career, a lot of people were looking at Eastern Europe, and at the time the region had massive current account deficits and it was overheating, and I was very happy not to look at Eastern Europe at all. Yeah, and the first time I ever looked at it was after 2008, when at the time I was working in London, and my colleagues told me, look, somebody's going to have to look at region, and that's you, yeah. And then I remembered that Boris was already holding this conference in Dubrovnik. I'd never been there, but it was a very famous conference already at the time. So then we met at the IMF annual meetings, and I said, Boris, could you invite me to the conference in Dubrovnik? And he said, yeah, of course. Then he didn't invite me. And the next year we met again at Proof in Chinatown, and I said, Boris, I thought you were going to invite me. And he said, oh, Christian, I'm really sorry. Could you give me your card again with your details? And then he didn't invite me. And then a third year, I sent him a Christmas card, and I put my business card in there. I said, Boris, Merry Christmas, see you in Dubrovnik next year. Since then, I've been invited here. And when I heard the first question here, I thought you were going to say, this is a great conference apart from the last panel. So I was really happy that you did not say that. So I hope I do get invited again. Yeah. Anyway, on the questions, 3 brief comments. The first one, I wanted to come back to Era on the issue of the fiscal use case for stablecoin. I mean, in the October 2025 annual meeting, there was a lot of discussion about what you mentioned, and at the time people said that the market for stablecoins would grow to 2 to 3 trillion, and then there would be an enormous demand for US T-bills, and the US government would be able to fund itself and actually also monetize its debt with the help of stablecoins. Turns out that the demand for stablecoins right now is capped at 300 billion, yeah, and it turns out that there's not that many people who are willing to forego interest payment at all, all of their interest payments in order to get into stablecoins. So I think this is a bit of a dead animal, the stablecoins. And then on the issue of the zero lower bound and stablecoins, I have a slightly different opinion from Chris Waller on that. Stablecoins that are issued under MICR or Genius Act are required to be invested in T-bills, so or money market instruments. So imagine we move to a world where the central bank goes back to a negative interest rate, yeah, and you force those stablecoins to redeem at par and simultaneously invest in instruments which have a negative interest rate. Now, that would not kill the ability of the central bank to impose negative interest rates, but it would kill the instrument of stablecoins. Yeah, so stablecoins would die, yeah, in that world. And this is why I don't think that stablecoins will constrain the ability of the central bank to impose negative interest rates. And finally, on the issue of what's the use case for stablecoins, I totally agree with what Marcelo has said. CBDCs are European CBDCs are a European payment system through the back door, yeah? And of course, it would be preferable if the private sector were to do that. Yeah. Now we know it's a duopoly run by foreign companies. There are high barriers to entry. They want to preserve fees. And if you look at the Brazilian example, it took the Central Bank of Brazil to establish PIC, for transaction costs to decline, and everybody to have access to a payment system. No, so I think it's the second best solution. Yeah, to get a proper European payment system, and this is what CBDCs can achieve. Yeah.
Okay, so the rabbit would die.
Yeah, I have to say I didn't have a discussion about negative interest rates on my bingo card today. Inflation's going up in the UK. So I think if we do end up in a world where we're contemplating negative interest rates, we might have bigger problems than whether stablecoin or tokenized deposits will take off more. But I do agree that, stable coins will be toast in a world with negative interest rates. I just wanted to add to something that David mentioned about multinationals probably preferring tokenized deposits rather than stable coins. I think it's also because, of course, tokenized deposits have access to central bank backing, whereas stable coins don't at all at the moment. There's talk of maybe setting up some sort of central bank programs with punitive pricing if need be in the name of financial stability, but they don't exist. We know how to backstop banks. We don't know how to backstop stablecoins, nor is that the job of central banks. So I think that makes them more attractive as well. And then just one last thing, Chris, you just happened to mention, what if your account gets hacked? And I guess I thought I'd just mention all these things can get hacked. And so if the point is to speed up transactions and have contracts happen automatically off the back of atomic settlements, that sounds great, except for in a world where we might have all this stuff hacked. And so I do think that all these institutions, financial institutions, will end up having to pay more and more and more for cybersecurity to stay ahead of the AI. And that's an unfortunate cost, but will be table stakes for everyone.
Which might be a good last question for the panel. What if we have Mythos 5.0 and Google comes with this type of high hacking power, AI powered devices, and at some point, there is a proliferation. It gets into the wrong hands, and deposits get blocked.
The answer is simply
in some banks.
You need redundancy.
So we then have at the Dubrovnik conference a panel on the going back to cash bills of exchange, because we will say, bring your money to us, we are offline to the vaults, to the safes, and then Catherine is back into the game. There we go. Sorry, David, you go.
You want me to speak on that? That's outside my pay grade.
No. You just say whatever you want.
Oh, yeah, okay, sure. That's great. I thought I'd comment very briefly on the negative interest. I wanted to say something because I'm so surprised. I actually agree with something that Chris just said.
Chris Waller? Or?
No, Chris Kopf. Against Chris Waller. I do think that negative interest rates would be feasible exactly for the reasons you said in that type of environment. I mean, if to the extent that stable coins will be required to load up on short-term T-bills, and to the extent those rates went negative, what would stable coins do? I differ, saying that that's the end of stable coins. They'd simply charge fees for this service to recoup the revenues they need. The other related issue is what would happen in an inflationary environment where stable coins are presently not permitted to pay interest. This is what happened to commercial banks in the great inflation of the 1970s with Regulation Q. I'll tell you what's going to happen. You're going to see a major stablecoin lobby, and they're going to change the law and permit stablecoins to pay interest in an inflationary environment. And believe me, we're not far from an inflationary environment. I think that I wanted to offer some way of reconciliation here, I think, because we got on the one hand, Chris Waller saying, what the hell, CBDCs, what are they good for? We got Chris Kopf saying, stable coins are snake oil. I mean, my own view is I've written a lot in the past on all these things, and I've adopted a view. I'm rather agnostic on the whole thing. I think at the end of the day, what really matters is that these systems, whatever we design, are well designed. It could be a CBDC, it could be a stable coin. I mean, as long as you have the proper rules, regulations, backstops in place, I think that they could, all of these designs could work tolerably well. That indeed, I think it's a good idea that different jurisdictions experiment with different versions. This is just let 1,000 flowers bloom, and let's see which system works best.
I think this is a very good ending of the panel. And guess people want to go to the beach, so I will conclude the panel. Thank you very much.
I want to say one thing.
Yeah, please.
I want to say thank you to you for hosting us here in this beautiful environment. And I had the pleasure of hosting Boris in Miami. Ricardo and I had him serve on a panel that we had in Miami last fall. I know that the city of Miami will never be the same. And I know you'll be soon spending a lot more time in Frankfurt, and I'm not so sure if Frankfurt knows what to expect. But we'll, so thank you to you, Boris, and everybody involved in organizing this amazing conference. Thank you.
Thank you. Paul?
You know, every year I usually get up here at the end of the conference and say, thank you for coming. Send me your ideas for next year. Goodbye. But this year is a little bit different because today marks, as we all know, the conclusion of Boris's tenure as the governor of the Croatian National Bank. And we have to mark the occasion appropriately. I'll only do so for a few minutes because we know Boris is a dedicated swimmer, eager to get to the beach. And we also know, as we saw on that beautiful slide, that next week he's going to be rafting on the Rhine River. So we wish him well with his new responsibilities in Frankfurt as he becomes responsible for the well-being of 358 million residents of the Euro area, up a bit from his previous activities, responsible for a bit less than 4 million Croatians. So it's a order of magnitude of approximately 100 times greater responsibility, but we know that he'll do it well. Now, those of us who are real Dubrovnik veterans know that the Dubrovnik Economic Conference has trained him well for those responsibilities. You know, Boris was just out of grade school when DEC got started. And according to Tomislav's records, his first appearance at a Dubrovnik Economic Conference, looking very boyish and eager, was the third Dubrovnik Economic Conference in 1997. So it is with great pride and fondness that I look back on the years that followed that. You know, I've been dropping into Croatia once a year and watch Boris develop an understanding of the world economy, always grasping the right issues in an insightful way and intuitively grasping the best of economic research. Soon Boris became the vice governor and then the governor of the central bank, providing the bank and indeed the country with the leadership to bring a former transition economy. Remember, this started as the Dubrovnik Conference on Transition Economics, a former transition economy into the EU and into the Euro area. It has been a joy for me personally and an honor for my career to have had the opportunity to watch this progress over the last 3 decades. Being a generation older, I look at these past 3 decades with a certain paternal pride in what I've seen develop. Nevertheless, I'm concerned. I'm concerned that Boris will go off to Frankfurt without the watchful eye of the Dubrovnik Economic Conference seniors. And there are a few people in the room who've been here, who got to the Dubrovnik Conference before Boris made it. Marko Škreb, who left earlier this morning, was the governor at the time. He founded the conference with Mario Blecher, who was at the IMF at the time. Others who were there at the start included myself, Ricardo Lago, Evan Kraft, Jacob Frankel. Sandra, were you here at the very beginning? Oh, I'm sorry. Okay. We look at and we surviving senior members of the Dubrovnik Economic Community, Economic Conference community, are concerned that Boris will be going off to Frankfurt without having the benefit of our watchful eye to make sure he's doing the right thing. So we're concerned that he won't have all the tools he needs to conduct monetary policy. Perhaps you could open that up as I speak. And so with that in mind, we want to make sure that he has in his hands all the tools necessary for the appropriate conduct of monetary policy in the European Central Bank. So we wish him well and hope that he comes back to sort of keep it so we can keep an eye on him. What you see here are the basic rules of monetary policy, a set of dice.